A warm welcome to this new episode of Financial Institutions Leaders View. I'm Gwenaël Leboulet. I'm a senior partner and managing director at BCG. Today, I'm privileged to be joined by Sheila Patel. Sheila, thank you so much for being with us in the BCG studios. For those not knowing you well, let me introduce you quickly. You are the vice chair of the B Capital Group, a global multi-stage investment firm. Before that, you were at the helm of Goldman Sachs Asset Management, and as part of that, you were in Goldman Sachs Global Management Committee, in the Partnership Committee, in the Diversity and Inclusion Committee. And over 18 years, I believe, at Goldman Sachs, you had many leadership positions over 3 continents and 2 business lines. I'd like to start with what we call at BCG the new reality for financial institutions. What we mean by that is higher inflation, higher interest rates, a world that is partly decoupling across geographies, huge investments into a more sustainable world, and above all, the highest level of uncertainty from geopolitics to macroeconomics. And in the financial institutions world, I believe that this has already a major impact on economics. You know, if I take banking as an example, in the latest report we published on New Reality in Banking, we've shown that if I take the profitability of banks driven by higher interest rates, they moved up by 8 to 16 basic points because of that. That's already huge. And of course, most of that was already erased by loan losses provisions, for what we expect. But to come to you, Sheila, as an investor, how do you see that new regime? You know, is it challenges, opportunities, both?
You know, I feel like this new paradigm we're living in is a really interesting time for opportunities as well as for challenges. And so, thanks so much for having me for this discussion, because I really think we tend to look at the glass half empty in finance a lot of the time. But I believe there's definitely some half full aspects to all of this. We're in a very difficult time from a management perspective, as you mentioned, with higher interest rates, with unpredictable central banks in terms of how they try to address things, and actually a relatively buoyant employment scenario right now as well, which is another metric and lever, especially for the Fed here in the U.S., to try to manage. What do people in the finance industry do? It's also been an industry that up to this point has been quite fraught with innovators, disruptors, challenges to the traditional banking industry, and I'm sure we'll get into some of those, but also with opportunity as technology is applied in ways that it hasn't been before to help investors. And that's what I'm really passionate about. I'm really excited about where things are going for every kind of investor out there. I've spent the majority of my career focused on institutional investors, but also on high net worth and on retail applications for investing. And there's such a discrepancy right now in the access and opportunity to invest for all those different constituent groups. And yet a 60-40 portfolio, which many people were trapped in, is a relic of the past. So how do we get the future to everyone in a safe way? I emphasize safe because of some of what we've seen over the last few weeks in finance.
No, thank you. Maybe double-clicking first on the digital assets, relating to your passion for technology and new things and new pockets of investments as well. We've all seen the recent turmoil into that industry. We'd love to have your point of view, as an asset class, as an investor, how do you consider that? But also as a technology investment potentially, because there is crypto per se, but also the digital technology behind it, the blockchain and so on. How do you see that?
Well, I definitely see it as one of the big thematics that's going on in wealth management, asset management, and finance overall. As you think about the emergence of new technologies to give people access to wealth, before we get into the difficulties, particularly that digital wealth and crypto and blockchain have had, it's worth reflecting on some of the good. Some of the good is certainly disintermediating in places where financial institutions were perhaps taking a few too many cuts and bites at the apple in between. A great example might be in India, where the government was able to put digital IDs in place for almost 1 billion people. That's pretty incredible. Whoever thought they'd be able to do it, and here we are, they did it. That then meant they could use blockchain to get payments to rural areas and constituencies who usually had it pass through 4, 5, 6 steps with a little bite out of it everywhere along the way. Or think about populations that are known for extreme numbers of people that work overseas, like the Philippines. Digital technologies and blockchain can really help people that have big remittances get that financial benefit back to their home countries in a much more efficient way without having a bite taken out of it. All of that said, we're sitting in a world where we'd be remiss not to point out that in many cases, those are much less regulated applications than we're used to. And the excitement is always disrupting something old and stodgy like banks. There's got to be a better way. And we forget some of the good things about banks. They're often insured in many countries, your deposits up to a certain point. They're highly regulated, and probably a phrase that's on everybody's lips right now in the digital world that maybe wasn't before. There's segregation of customer assets. And so there are a lot of benefits to some of the things that regulation has put in place and the learnings from that. And I think that the marrying of the two, taking the innovation that we can see can provide real benefits to constituents that can use it and that can provide more safety, more reliability to the financial system, but trying to layer in some of the things we've learned from a few hundred years of financial system breakdown, many of which were about lack of controls and lack of separation of monies that were owned by others.
Yes, indeed. From the timing perspective, because in a way we were still at the beginning of the maturity curve, how do you see when there will be a relatively more stable, more regulated, probably, as you said, environment, where you and me as individual investors, and for some of the audience, we can invest our own money into these sources of capital?
First of all, you are seeing central banks themselves, you are seeing larger financial institutions get invested in the space. In many cases, now that the market's gotten more difficult, especially the private markets, I think many of the fintech ideas that have been standalone, that have worked somewhat well, will likely get acquired. It would probably be a period over the next few years where we will see M&A, where some of the ideas that financial institutions haven't been able to develop in-house. Innovation is so hard sometimes for a big company, particularly in a regulated industry, to take some of these things in-house, transform them, and make them a regular part of somebody's commerce, of somebody's ability in the financial space. I think about tokenization, for example, to go away from just crypto. KKR just did the first tokenized fund, and that enables such a larger group of investors to access alternative assets. And I think alternative assets and tokenization and the way the two can combine to provide access is a place we'll be spending a lot of time. As a quick statistic, the average high net worth investor has 50% of their assets in alts and privates. They're getting access to a pool of investment and to return opportunity that the average investor only has about a 2% allocation to in their portfolios. Tokenization, build out of alternative asset platforms for access, these are things that will democratize some of the areas where we've seen better returns.
And provide liquidity a bit more.
Absolutely, absolutely. Bringing some liquidity to some very traditionally illiquid assets.
I'd love to switch gear and go to the sustainability topic now. It's also a huge investment opportunity, to say the obvious. We've worked with the Global Financial Market Association, for example, and calculated that there is $3 to $5 trillion every year of investment needed to transform all industries across the world. So as an investor, again, how do you see that? Is the sustainable finance world shaping up?
Well, I definitely think we're in the, whatever you want to call it, the 2.0 or the 3.0. We've moved on from purely thinking about the investment opportunities as either extremely high CapEx opportunities or being opportunities where you are thinking about an infrastructure application or something, again, that's very government-led. I think that what has been discovered is innovation and sustainability has to come from every area. Public, private, at a more individual level and at a broader level. The application of technology is probably the place that, from an investment perspective, I see a lot of great opportunities. As companies have made commitments to net zero, how do they measure? How do they metric? What software, what enterprise applications can we bring to them that help them get more efficient? If the world of climate in particular is sticks and carrots, the carrots being more efficiency, saving money, finding ways to make your stakeholders happy if you have shareholders or other stakeholders demanding that you do more for climate. And you have a few sticks. You have regulators demanding that you take action, particularly across Europe, for example. You might have some other sticks of people that say, I still want to return, particularly for some of the pensions here in the U.S., where their legislatures and their political landscape is not quite as friendly to investing in climate for climate's sake, but for a proper return, you can certainly make the justification for it. And so you put some of those carrots and sticks together, and you add one last stick, Mother Nature, who wields it relatively unforgivingly, particularly if you're in a space, a sector like insurance, for example, or so on. And there are a lot of influences to try to get better at what we can do, to try to put better data analytics and metrics around what are the areas that could be most prone to damage in an ever-changing and more difficult climate environment, and so on. So I'm very excited about those applications of technology. And beyond climate, in general, I think AI can add a lot to the ESG metrics that you see investors around the world use.
That new world that you're describing, be it on the crypto side, on the sustainability side, and even on the new economic regime, is new for many of us. Take interest rate. You, me, many of the leaders of the industry, they not lived through an area of high inflation, high interest rates. I feel there's a huge people agenda behind it, which is how do you equip the entire workforce, the leaders, but also, the relationship managers, the back offices, the risk people, and so on in our industry, to be knowledgeable about this, to be equipped with the right things for them?
I think it's a bit ironic. Usually, if you think about high tech and finance and fintech and everything we've been discussing, the gray hair is the old, and you want to be a young, happening person. But almost at every age, people have not been in a rising interest rate environment. Fixed income traders have never experienced it. Equity analysts have not been sitting, watching rates rise, seeing inflation, thinking about the impact that could have on balance sheets and on profitability of companies they're working with. So you have multiple areas of expertise that now are sitting with relatively few, if any, experts left that have seen every type of environment. So I guess first of all, it makes you more excited to maybe be a little more valuable if you remembered rates going up. Even if you were a child, I cleaned out my parents' house a few years ago, and I remember being horrified at finding their mortgage with 16.27% written on the piece of paper from the early 80s. Let's hope we don't get there. But I think really what can benefit these groups that we're retraining, reskilling, and so on, is some of that effort to look back at some of the history, to engage with some of the people that were around, and you see that happening. You see a lot more interest in kind of going back, remembering what certain financial difficulties and crises were like. I also think you can look at different places around the world. Just because something hasn't happened in the US or Europe doesn't mean we haven't seen inflation and some of its impacts in Latin America, or seen some of the challenges that you can have when you have interest rates and issues from a fiscal responsibility perspective, and the way that Asia managed their way through that and ended up in a better place. So I also think that global sharing and assumptions that just one developed market or a couple of developed market regions hold all wealth of knowledge is probably a place we can do better.
No, that makes a lot of sense. And I feel that the speed in which some institutions will do that versus others will be a differentiated competitive advantage. If you can train that at scale, that makes a huge difference in what you can achieve. Huh? To stay on the people front, to close with, I know you stand for diversity and inclusion. You were fighting for it at Goldman. You're fighting now in your world of venture capital. You're fighting for that as well. I know you're part of the Princeton initiative on that as well. So, and the world of finance has not been the best in terms of diversity and inclusion, to say the least. So,
You're generous.
Where are we today, and how can we accelerate that agenda even further?
Sure. Well, I'm very lucky in that B Capital is ranked in the top 10 of most diverse venture capital firms in Silicon Valley and probably in the world. And that was before I arrived, so they didn't need me to get there. But I think overall, when you look at the world of finance, it hasn't made it any easier for people, and now you're seeing it for men and women. It's not the attractive place it was to work because people don't want to live a lifestyle that doesn't allow them to be their whole selves, right? And whether they're trying to have families, whether they are trying to work remotely some of the time, whatever it is that adapts this very demanding, very rigorous, hopefully highly intellectual pursuit of working in the world in finance, and allows it to be coupled with a lifestyle that makes sense and is realistic, probably helps our diversity most of all. I'd also say that, there's no lack of ambition in the women in particular that I meet and that I mentor. But sometimes channeling that ambition and having it be allowed to flourish means taking more risk. And I think I've always advocated, and I continue to advocate for women and for anybody that's sitting and has diversity as an important aspect of their well-being and who they are, to consider taking more risk, to consider looking at an opportunity that means you change jobs. The next generation, of the last few years and ahead, they're much more comfortable not staying at the same place the whole time. That'll force existing institutions to get a lot more competitive to keep their best people, not just the best people that conform to a particular type. But it also lets people be competitive, see what the right aspect and the right opportunity is. And that might mean more compensation. That might mean a better lifestyle. That may mean becoming the CEO of a company rather than waiting for intermediate jobs at a bigger place where you're sitting today. And I think you're seeing that happen, which is very exciting.
Great. Thanks so much, Sheila.
Thank you.